Today, my viewers, I want to talk about the language of business. And what is the language of business? When we go out into our particular industries, whether it's air conditioning, electrical, plumbing, painting, auto mechanic, or even real estate, there's a different language to learn in all those businesses. If we go into that business, we have to learn that language so we can communicate with our fellow employees and the owners of the company, plus a lot of the vendors. We have to understand their language in vendors in the supply houses. But the language I really want to talk about today is the language of money. The language of money is probably the most important language that you really can learn. And that's in business, and that's in personal. You have to understand there's honestly probably 200 different terms that you really need to learn. I'm going to cover several of them, but I'm not going to cover 200 of them because some of them are on a private level as individuals, and some of them are on business levels. And I want to cover a lot of them on business, and I will cover some of the private individual type terms that you need to go, especially when it comes to mortgages and banking. And some of them actually overlay each other. But so today I just want to talk about, I printed off about 17, 18 different terms. And I just figured these are some of the top terms that you need, but this is just the start, guys. Accounting. Accounting is something that you do. You keep track of all your money's coming in and all your money's going out. You have to understand where the trail is of where your customers are sending your money in through credit cards, checks, however you're getting your money, but you have to keep track. And that's what accounting is. That's what accountant does. They track your money for the year in and for the money out. And the bottom line is they're trying to see how much profit that you make. That's what accounting is all about. We're going to talk about a term that considered very important to me when I was in business. It's accounts payable. This is money that you owe to your vendors, money that you owe to your landlords, money that you owe to the banks. This is money going out. Accounts payables are money that you're responsible to pay back. That's why you have to work and each month, and you got to keep this balances current. Accounts receivable. That's money that's owed to you. That's money your customers owe you that you've worked for, and they're going to pay you with, like I said, a credit card or a check. But accounts receivable, you have to keep up with this very closely. I kept up with that weekly. I knew pretty much exactly what everyone owed me. You got to keep up with that. Important. Assets. I just broke it down real easy. An asset puts money in your pocket. What puts money in your pocket? Your vendors giving you the material at a discount and you sell them to the customer. That puts money in your pocket. Your employees being well trained, working proficiently and very well, that puts money in your pocket. Your trucks that work every day on the road that get your jobs from point A to point B, that's an asset. I consider that an asset if it's paid for. I personally never bought brand new vehicles, and I consider them an asset when they were paid for and they were getting me and my employees to my customers. Asset covers a wide range of things. An asset could be a building that's paid for. Asset could be tools and equipment that's paid for. An asset could be a machine shop, a duct machine, a sewer viewer, anything like that. As long as it's making you money and it's really paid for, that's really an asset. But there's also assets in your company that are not totally paid for, but they are making you money. An asset puts money in your pocket. That's what you need to remember. Liability. We all know what liability is. That takes money out of your pocket. A liability is anything that costs you money. One thing is a constant liability is your rent or your mortgage for your building. It could be your electric bill, your water bill. It could be a truck payment. It could be a bill that you owe Your vendors, that's a liability. Although we just talked about up here as accounts payable, but that's a liability to the company. That's why you have to work and make so much profits in order to pay these off. But a liability takes money out of your pocket. That's a simple way to put it. Revenue, what is revenue? That's really what we're all working for, is revenue. And that's income received from customer service. Revenue is the money coming in from your services. I am an HVAC company and I'm out servicing equipment. I'm out replacing equipment. My customers are paying me. That's revenue. You take all that revenue in one pile, and you start taking everything out that everybody else gets. That's your accounts payables, which is your vendors, your employees' wages, your IRS, your taxes, and then you got to pay yourself. Always pay yourself a wage, okay? But revenue is a term that you've got to know what it means. Retained earnings. That's money's left over after all the taxes, liabilities are paid. And I put used for buying assets. So what I would do at the end of the year, I would work, and we'll just use an example of $100,000. After the end of the year, I've paid all my employees, and I paid all my vendors, and I paid all my taxes. I had everything paid for, and I had $20,000 left over, let's say. I would put that into a separate account, and I call that retained earnings. That money did not create a tax event. It was like a layer of business savings, okay, which I didn't use for business. That's another story. So I would take that money after it accumulated so much, and I would buy assets, be it real estate, land, pay off my building, whatever that asset was. But you use it for buying an asset, and an asset does what? Puts money in your pocket. Okay. Another thing that you need to really understand is marketing. When you get into a business, marketing is something we have to do almost from day one. First of all, the biggest thing you're marketing is yourself. I am the one that's creating the business. I'm the one that's giving birth and life to this particular entity. And the first thing I have to market is myself. I have to have a good personality. I have to be outgoing. I have to be what we're going to call a people person. Because I'll be honest with you, if you're introverted and you're laid back and you can't communicate with strangers, you're not going to do well in business, okay? But marketing is engaged to influence customers, and that's branding, that's websites, that's your YouTube, that's your Instagram, your Facebook, that's your trucks, that's your office, that's your business cards. Marketing is engaged to influence customers. You want people to come to you because whatever business that you're in the customer business. You're in the customer service business. Without customers, you don't have anything going for you. Capital. What is capital? Capital is cash used to create wealth. A lot of businesses, when they start with an initial capital investment. A lot of times it's your own personal money. Sometimes, depending on the business, you may take on partners. So what you really want to do is you want to get this business going. You want to put your capital into that capital reserve account and hopefully work your business without ever touching this. But that capital is there to help you move forward in the business. Eventually, you need an infusion of cash. You need money to help grow the business. It's what you're always trying to do. It's there. Eventually, after the third year, you should have enough money in your business savings account to put that money in case you need to buy a piece of equipment, a copier, a printer, a truck, something to do a job. You'll be able to take that money out of your own business savings plan and use that money. But capital is a good thing to have to get business started and have that cushion. Okay, it's a security blanket, I call it. EIN number. We talked last week on a video. EIN number. That's the employer identification number. And that's what the IRS uses to identify your business. Everyone has an EIN number. If you don't have an EIN number, you have to revert back to your Social Security number. The reason you want an EIN number is so you can set up an S corporation or LLC, and now you're a legitimate business as far as the IRS is concerned, and then you can write off things off the IRS that are legitimate, of course, which is your gas, your office experience, business, your office space, tools, employee labor. You can write off a lot of things. That's where your accountant comes in. That's what she's doing. She's accounting for all monies in and out. But you got to have an EIN number. The next thing I want to talk about is an audit. Audit is something you really don't want to go through, but I will tell you this about audits. You have to keep good records. You have to have good record keeping. I recommend everyone in business hire an office manager after they start getting 4 to 6 employees, somebody that's well organized, and they have an accountant to follow up behind her and watch everything. We put everything on QuickBooks. But when you get audited, if you don't have your ducks in a row and everything's not really accounted for, if the IRS is auditing you, you can really get yourself in trouble. You can have to pay a lot of money. But a lot of times banks want to audit you. And sometimes, depending on what type you're doing, if you're buying a builder or something, the value, sometimes the owners want to audit, and the banks want to audit. Anyway, just be very careful. Follow up to everything, okay? Balance sheets. Balance sheets are a snapshot of business, of assets and liability. Assets minus liabilities equal equity. Now, a balance sheet is something that you as an owner actually should learn how to read, just like you need to read that accounts payable. There's accounts receivable. You need to learn how to read these. I used to print mine off each week, so I knew where my balances were, how much money came in, how much went out, what I owed, what I was owed. Just get a snapshot of the health of the business. Are we healthy? Are we able to run a marathon? Are we just barely moping along? But balance sheets are very important. Equity. Equity is money you have invested in your business. Equity is, a lot of it is goodwill, marketing, trucks, tools, advertising expenses. Equity is something that you have to invest in your business in order to keep it growing and keep it in the forefront of your competitors. If you don't have that in place, you won't survive very long. Equity is assets minus liabilities equal equity. It shows the value of your business. This is a very important term for you to know right here. Depreciation. Lifetime of useful life of assets, such as equipment and buildings. Basically, when you do your accounting, your accountant is going to say, you bought a truck, you get maybe a 5-year depreciation. You bought a building, you get a 30-year depreciation. You bought a specific piece of equipment, you get a 10-year depreciation. Depreciation is helpful on your taxes, and as the years go by, you get to write that much money off on your taxes each year. Let's say it's $30,000 and it's a 10-year depreciation, you get to write off $3,000. That's the way that works. So that's why you want to spend money on your business, because if you don't invest in your business, you'll end up paying more taxes, and then you won't have the equipment to do the job and make more money. The government wants you to grow. They want you to make money, okay? If you will follow the laws of the IRS, and if you'll follow what they're allowed to give you deduction-wise, you will be profitable, because they really give you a lot of breaks on your 401s, your Roth IRAs, your depreciation, your taxes, depending on the bracket you're in, the HSAs. There's a lot of things the government will do for you. You just got to be legitimate and do the right thing. Income statement. That's the profit and loss. And I wrote it down like this. The income statement is the profit and loss coming in. That's money's going in and money's going out. It shows financial performance. That income statement is very important. That's something that your accountant a lot of times will give you every quarter or every 6 months, because you want to understand what your health is, again, of the business. A financial statement really shows if you need to make changes or anything like that. It shows you what you need to do. Okay, that's very important. Learn that term and learn what that means. And then I just wrote down here fiscal year. Fiscal year, a lot of times for businesses, is January through December, January 1st through December 31st. That's where you want to just work and do everything you need to do throughout the year. But if you're going to make any major purchases, you want to do it before end of the year, before December 31st at midnight. Folks, there's a lot more terms that I didn't get into here. I am going to go through these more. I'm going to pick out probably top 40 or 50 terms that you need to know to do a basic business. I'm not an accountant. All I'm trying to do is teach you some language here of the business. I want you to understand that it's important for you to understand these terms, so when you're talking to your accountant or to your banker, that you have understanding of these words and what they really mean, so you can function well and know how to make choices. Because sometimes as an owner, you got to make choices on the fly, but in order to do that, you have to understand the language. If you like this video, please share, please subscribe, and please comment, and thank you for watching.